to the West Coast. Thank you for being here. Already, we got 21 people watching. That's so awesome. Go hit that like button when you come into the live stream. The algorithm will pick up the video, start spreading it around for more people to join in on the conversation. I'm going to be out here for maybe a half an hour or so, and we're going to talk about the bankruptcies that are taking place all over. Now, if you just do a quick Google search, just put in the Google bankruptcies and hit the news feed and just look at the amount of bankruptcies that are happening everywhere. In every kind of industry that you can imagine, there's bankruptcies taking place. And now, personally, when I look out at the economy, I look from a retail point of view because that's my day job. I literally ring up 2x4s, sell hardware at a local lumber yard. I know more about retail than what a lot of people experience out there, since I'm in it firsthand and I have a view of macroeconomics. I don't mean to brag about it, but it's a pretty unique position to be in. Now, something else that I have experienced in my past is the shutdown of lumber yards. Like, I worked for 2 failed lumber yards that went through bankruptcies. One back in the back before the great financial crisis. What was it? The .com bust, right? That was one time, and then the other time was the great financial crisis. It was a few years later. In fact, I did some great videos that were titled Tour of a Dying Business, where I actually went around through the company and showed like the store and, you know, how it was depleting inventory and all kinds of stuff. And it was a pretty good video, I thought. Now, my experience with those companies and watching the failure take place and watching the receiverships come in, there is some clear signs of stuff happening before that took place. And one of it was the biggest sign, obviously, was the slowdown in transactions that were happening. And man, are we experiencing that now? So the difference between the stores that I worked at before and the one that I work at now is the one that I work at now is owned outright by the owner of the store. I mean, he doesn't have a loan out on the business. Maybe a little bit of equipment if I remember right, but for the most part, there's no bank, there's no lawyer, there's nobody who's going to come in and you know, take the store from him because he's not making the payments on it, much like what was taking place through the companies that I had worked at for in the past. So some of the things that we're experiencing now with this slowdown is going to eventually get noticed within the economy. Now, I'm experiencing it firsthand. There are a lot of other people who are starting to report on it, and just take a look at like a bunch of the links that I had left. There's bankruptcies happening like everywhere in every form, right? Now, again, this is pretty difficult for a lot of people to necessarily see it. When you have like things like the stock market that is doing so well, and then you have like the mainstream media talking about how great everything is, and then you got the Federal Reserve saying, "Oh man, we may not have the ability to lower interest rates going into the future because of how awesome everything seems to be going with the inflation and growth and everything else that's going on." I find it to be pretty ridiculous, really, when you look at it from my own personal business point of view and the things that I am seeing out there. It's slowing down, and it's slowing down dramatically. And so what I assume is probably going to be happening here going into the future is that the liquidity that is tightening up, right? This is the Federal Reserve has pretty much gone into the reverse of money printing and is doing quantitative tightening. This quantitative tightening is pulling money out of the system. When you start pulling money out of the system, it's not nearly as easy to acquire when the cost of buying money, it has an interest rate that is as high as it is. That really slows the economy down, right? If you cannot have access to loans, if businesses do not have access to loans or are taking out less loans, that's less money that's going out into the economy, less transactions that are taking place, and this is the economic slowdown that is really going to be, people are going to experience in a major way as we move closer into the into that liquidity crunch time period. So it's hard to like time this out, like how far out into the future, like when that liquidity is finally just too painful for the Federal Reserve to not act upon it and start lowering interest rates. There's going to be some clear warning signs that are going to be heading up before that actually happens. And the Treasury has already pretty much stated it as well, saying that if there's ever liquidity issues happening within the bond market, they would step in and start buying those bonds. But in the meantime, businesses are going to start failing. And it's easier to understand that the businesses are going to have a difficult time going into the future than it is to try and understand how it is that they are going to survive, right? I mean, it's not going to be easy, and that's the only way I can really say it. Now, if you are with a company that is not like incredibly indebted, well, then you might be able to just like kind of coast by for the next, year or so, and maybe have an operational business at the end of it. But if you're a heavily indebted company that relies on ever increasing amounts of rolling over old debt into new debt in order to keep the business functioning, it's probably going to fail. Like, that's the only thing I could really assume. And it's just like really anybody out there. I mean, if you have an income that is exactly meeting your monthly bills, and all of a sudden you're having to drop an income, well, then the bills overwhelm you and you start, going into the same consequences of default on your loans and eventual bankruptcy if it gets really bad. And, so you can just kind of look at it from your own point of view, if from a personal point of view, as if you had a lack of income. Well, these businesses are the exact same when it comes to like debt issuance. If the debt issuance isn't being produced out there, whether people are taking it out car loans and house loans and borrowing money extensively on credit cards, well, then those are the failure transactions that are going to keep these businesses moving. And again, this is what's happening right now. My only like suggestion that I would ever give to anybody is to get out of debt as quickly as possible. Cut all like, non-necessities out of your life. Like, only buy the necessities and get out of debt as soon as possible or as quickly as possible, because it's only going to get worse from here. There is no promise of reversal, right? The Federal Reserve and the idea of lowering interest rates, even if they were to do that, like, even if they were to say lower interest rates this exact moment, it takes anywhere from 6 months to a year, and probably even longer, before it has any kind of real impact to the economy. So if you're thinking, oh man, at the end of maybe at the end of summer, we might have some better economic times due to the lowering of interest rates, no, that might give some like false hope, and it might get the markets to react in a way that might look as if it's a benefit. But ultimately, the lowering of interest rates doesn't have a real impact for anywhere from 6 months to a year, even 18 months down the road. So now you think about it right now, the impacts to the economy due to the raising of interest rates that happened 18 months ago, right? That's what we are feeling now. Whatever happened 18 months ago, we are now feeling the full effects of that. And this is one of the reasons why I believe the economy is slowing down as much as it is. Other people will argue, well, yeah, but look how great these other parts of the economy are. There's a very odd illusion that happens within this when you have so good a numbers coming out on like the stock market, which really confuses people, because they look at like the Dow and they look at all these stocks and they say, hey man, look, the economy is doing awesome. That's not the stock market, or that's not the economy. The stock market is not what is not portraying what's going on in the real economy. Okay, there's a very big difference inside of that. And one of the issues that we are facing right now is the neutral interest rate that is rising due to the higher inflation expectation going into the future, which this right here is a very hard concept for a lot of people to wrap their heads around. But if you can understand that if there's an inflation expectation that is elevated going into the future, that begins to raise the neutral interest rate. Now, this neutral interest rate is the rate that is neither accommodating nor restricting the economy. And if the Federal Reserve maintains the Fed funds rate at a particular level and the neutral interest rate begins to rise due to the higher inflation expectation, it makes the economy less restricted due to the high Fed funds rate. Does that make sense? Like, as the neutral interest rate rises on the inflation expectation, but the Fed maintains itself right where it's at, the restriction to the economy becomes less. And that right there starts putting like the imagination of better economic times going into the future when you start looking at things like the Dow and, investments like the return on capital investment and stuff like that, which is actually a pretty good deal when you really think about, like, the longer the interest rates stay elevated, that return on capital investment actually starts to benefit the economy and starts ramping things up. In fact, you're going to start finding articles, if you're not finding them already, talking that exact scenario, right? But it's, again, like, that is limited in my belief to the amount of economic activity that is actually happening out there, right? Just because you're getting a good return on your money market investments or just your capital investments in general Unless that money is actually getting spent back into the economy, generally it's going to get rolled back over into the investment again, and where it's going to attempt to collect interest rates, which is not necessarily taking part in the economy itself as far as, providing more economic activities through transactions, right? So you make some money off of the capital investments that you have had for the last couple of years, you take the profits from that and you go and spend it into the economy. A lot of people are just taking that and saving it by rolling it right back into the investment again and not actually spending that money. All right, so we're 10 minutes into it. I just kind of wanted to bring this one up for a lot of people to join in on this discussion. I'm sure from your own point of view and some of the businesses that you are in, you may actually see it quite differently, saying, no, man, things are absolutely rocking here. But I can tell you from the retail point of view, and also with the discussions of vendors and wholesalers and other retailers out there, it seems to me that there is a dramatic slowdown happening within the retail space, and I can only imagine that it will eventually lead into your daily news broadcasts as well. All right. I don't think wages will rise that much since the labor market remains pretty strong. This is coming from John. Let's see, all-nighter. The dollar network is a Chinese finger trap. Brody, lots of laugh out loud at all-nighter. Good one. All right. Good analogy, all-nighter. All right. Dylan, I hope wages go up, insurance getting too expensive. All right. Dylan again says, no room to bump rents, already 40% of incomes. Yeah, and this is probably, there is no better sign of the money is at an abundance than the rents and leases that people pay, right? And actually, that's something that comes out of Cantillon's essay, right? If you go and you read through the increase and decrease of money to a state, that's one of the last things that he says, and I don't know exactly where it is in here because I would have to go and research, read through it before I could just pinpoint it out to you where it is in this book. But he's basically talking about the signs of an overabundance of money. And that's where you see it. You see it in rents and you see it in leases. And once you see rents and leases like at an extreme level, then the abundance of money is flowing through the system. This is what we're experiencing right now. And it's not like, to me, that's not something like government can do anything about. Like, how do you produce more, like, how do you make it available for people to be able to buy a house? You can't lower like interest rates to make the capabilities of the people to have the purchasing, to be able to make the monthly payments on a house. That doesn't provide more houses. What that does is provide more buyers, right? So what that does is if you have a buyer supply, like, a supply demand imbalance, due to the fact that you have a limited amount of supply and then you just start adding more buyers to it, right? More demand, then that causes the prices to move up. Literally, there is nothing that government can do except for attempt to restrict the purchasing of homes by the people who are begging for the ability to buy homes the most. Right? All these people are saying, I can't afford it. I can't do it. I can't do it off my, my wages. I can't do it for my income. The houses are too expensive. The interest rates are too high. And if they lower it, the problem gets worse. Right? And if you raise the interest rates, the problem gets worse. No matter what, there's going to be the problem. It's going to get worse. And that's due to the fact that there's just simply not enough homes out there anymore. Simon, do you have any idea what the general situation is like for capital groups who are responsible for people's future well-being? Pension schemes, say? I don't, but I would be very nervous with a lot of these things that are out there. See, here's the major problem that I find with like a lot of pension fund kind of things is that there's a very, like, they're limited to the type of investments that they can buy, right? AAA rated stuff. Say, for example, so like, these people who manage these pension funds, when they go to buy an investment, it has to meet this credit rating. Like it's just like, you can't go and buy a bunch of junk, right? You have to buy stuff that's good. The only problem with this is that you got things like the collateralized loan obligations, right? And if you're not familiar with like collateralized debt obligations, collateralized loan obligations, it's much like a mortgage-backed security kind of thing. And so if you have collateralized debt obligations, collateralized loan obligations, these other like loans that have been jumbled up into a security, right, that you can buy. Here's the problem with this is that a lot of times the stuff that is going into these securities are like junk rated stuff. Like the pension fund would typically never be able to buy any individual one of these investments that go into this security. Like not a single one of them has the credit worthiness for these pension funds. However, these smart people can get these things together, chop them up into different tranches, right? So now, as all these companies start to pay their bills, right, you got the upper tranche that gets paid first. So no matter what, like not all companies are going to default at the exact same time. Some of them will, some of them won't. But the ones that do pay will pay that upper tranche first. That is given a AAA rating and now is being sold to pension funds. But nothing within the investment itself is credit worthy for the pension fund. But if they do this little scheme, then they can be. Right? So this puts me into like a very nervous position when I think about like what's taking place out there with these pension funds. And then another thing, like this is something that's been going on for a while, is the daisy chain of financial, like financial manipulation. I'm not sure exactly how to describe it, but if you can imagine again, a pension fund that buys into high yielding debt, or not high yielding debt, but high quality debt, right? So basically buying into junk bonds that have the credit worthiness. Those companies then borrow this money from these pension funds, which then in turn they go and buy their own stock, which drives the stock value up. And again, these pension funds are looking good at this, saying, hey, this is like increasing our value of our pensions or whatever it is that's happening out there. But they are literally loaning the money to buy their own stock that's driving it up. Now, if they ever come into a situation in which that company needs to pay back its debt and it cannot find the money because of the slowdown in economic activity that is happening out there, so now all of a sudden their goods and services aren't selling nearly as much as they once did. Well, now they need to figure out a way to make that debt payment. Right? And now you can lay people off, you can start selling off equipment, you can start selling your stock, right? So now the next thing you know is your stock prices are going down, and it's an attempt to try and pay these bonds that are now losing value because of the credit risk that is involved with it. So again, like, this is all pension fund, like funded. This is all pension funded kind of thing, and not all of it, but a good chunk of it is, Don't forget to hit the like button. Yes, please. Thank you. Let me cruise down here to the bottom. We got 378 people watching. My gosh, you guys must love that title. All right, so it's just it's just the way it has to go. Owen, 100% right, self-inflicted. Owen Baird says people wouldn't be struggling as much if their finances weren't consumed by personal debt and or living above their means. Yeah, and I really agree with that, Owen. I have to take it for my own personal, for my own personal view in my own life. I would love to go out there and buy that beautiful new Camaro, man. Like, I really want it. Like, I would really love to drive around on the weekends, blasting like the stereo real loud and looking really cool in that thing. But I'm trying to buy real estate. I'm trying to buy my house. I would love to get into more real estate in the future. I'm trying to build up a stock portfolio. I got things and responsibilities that I have to deal with that don't include having a new car. So, yeah, I would love to have a new car, but I'd much rather have a house, right? So I'm not making car payments. I'm not going to do it. I'm going to drive this 99 Ford Explorer, and if anything happens to it, I got a 2001 S10, and if anything happens to it, I got a 99 Toyota Corolla, and that's going to be my transportation as long as I can make it happen without ever buying a new car, because there's so many more things that are important than a new vehicle. And it's just like, I think about like all these people who tell me, it's just like, man, I can't afford a house. And I'm thinking, you drive a nicer car than I do, right? A way nicer car, even a nicer car than my wife drives, and my wife is paying for her own car. She like goes and works. I pay all the bills. She pays for her car, and it's like, I still don't understand how it is that people are going out there and buying these vehicles, but I guess I do, because they complain that they don't have a house, and so, what do you want? Priorities. All right, Maxim, thank you so much for the $10. All right, I try to rephrase my message from previous stream. You'll end up with Nvidia and other bubbles in your 401, while people who converted their stock bubbles into cash on time will own your house. Yeah, I can believe that, man. Um, all right. Thank you for the super chat, man. I really appreciate it. Wow, 400 people watching. I love it, man. All right, Dylan again. They need inflation. Aren't they still fighting off deflation, aiming for average and 2% inflation? Seems to me like they need to be higher, bit longer. If do more now, wouldn't it let them go closer to 2 sooner? Let me see here. Aiming for an average 2% inflation seems to me like they need to be higher, but longer. If do more now, wouldn't let it them go closer to 2% sooner. Yeah, if they let more inflation happen, then I guess what you're trying to say is like, because a lot of people, and let me kind of explain what Dylan is kind of getting at there for a lot of people who are new to the channel or haven't been following my economic theories, or at least my understanding of the monetary theory that we are experiencing right now. A lot of times when people are looking at the Federal Reserve and the inflation fight, they think that the Federal Reserve is trying to prevent inflation from taking place. That is absolutely not right. They are allowing inflation to happen because they are trying to make up for the deviations from the 2% target that they failed to achieve for the previous 10 years. Now, this is really important to understand because it's definitely part of their monetary policy. It's something that I have brought many videos and evidence from documents coming from the Fed, even in the congressional testimony that took place, what was it, 2 weeks ago? Not even 2 weeks ago. They straight up asked Jerome Powell about the 2% average inflation over time and how they are allowing inflation to run above the 2% target. If they are allowing it to run above the 2% target, then the 2% is no longer a target. Literally, like if you are aiming at 2% and they say, hey, we got to shoot for above 2%, you're no longer aiming at 2%. You're aiming at above it, right? And that's the difference that I think a lot of people really need to grasp a hold of, is that the inflation fight was for the fact that they failed to achieve inflation over the last 10 years. Now that they have inflation scenario taking place, it's the inflation expectation that they are trying to attempt to keep well anchored, right? If the inflation expectation begins to fall, it screws with their monetary policy in a way that they can no longer conduct themselves in the way that they traditionally would, with the lowering of interest rates and the stimulating of the economy in that fashion. So yes, I agree with Dylan on that. If they allow the 2% to stay elevated, or the inflation to stay above that 2% target for a significant amount of time, it will achieve the 2% average inflation rate that they are looking for, not the 2% target. Because in again, like if you're not familiar with that monetary policy, it just seems so confusing. Is it a target or is it not? Like, what's 2% average inflation? What's the formula for that? Average inflation rate over what kind of time? They don't give us the timeline. In fact, Jerome Powell straight up says, we do not have a mathematical formula for figuring out what the average inflation rate over time is. Like, it literally seems like it's arbitrary to the Federal Reserve, but that's not really the case either. Like, the Fed knows that there was a 2% average at some point in the past. Like, if you take the inflation that we are experiencing today, and you consider like the inflation that had happened over the last year, right? And you average that, it is way up there. Like you got an average that's, I don't know, I'm just going to make up a number, 6%, right? You have an average of 6% over the last year. You incorporate the year before, it might be even a little bit higher than that. You start incorporating the years before that where the inflation wasn't at that high level, but actually was under the target of 2%. Well, now you have to incorporate all this high average or high inflation and the deviations into your average. And if you start looking back far enough, there is a time in which, if you incorporate all the inflation that we are experiencing today in the recent past, all the way through the distant past, you will find a time back there where it was 2%, where the inflation averaged 2%. Now, how far back you have to go is anybody's guess, because I can't find any kind of mathematical formula for figuring that out. Like there's no chart or anything at least not that I have found, that takes today's inflation rate, averaged it all the way back until you could find 2%. right? And there is I don't have it right here, but there is a Fed document that talks about that, and they call that past looking, like past looking average inflation, but it eventually could flip over to forward looking average inflation. And again, this stuff is so hard to just wrap your head around. I don't think I can just blast it out in another 5-minute video. Really, it takes about a 40-minute video to really explain all that stuff. But if you go and you look at some of the videos that I've done just even recently, it explains all that stuff. All right, 458 people watching, man. I'm loving it. Go hit that like button. I'm going to be out here for another probably 10 minutes or so. All right. Inflation is consumption. If supply go up, demand go up, prices go up, so inflation happens. So if average of 2% enough to keep the economy growing at a good rate, but not too fast as parts lack or if we hit. Yeah, and I think that's kind of the idea, is that a 2%, a 2% inflation is really not that noticeable to the average person who is like, just living their daily lives. Like, you think about it, if you have something that's growing at 2% a year, it takes like what, 35 years, 30 years, 35 years or something for it to double. So really, if it's going at 2%, that's a pretty slow increase in prices. And yeah, it might double over the course of 30 years, or maybe an item might double or even quadruple over the course of your lifetime. But ultimately, like, if you're kind of experienced or used to the expectation of having some sort of low level inflation, that probably wouldn't impact you that much. It's the dramatic move of prices that really just shocks everybody. And that's not like your typical inflationary scenario, especially like when you look at real estate right now. I mean, real estate is off the charts. And in my opinion, it's only going to get worse. Like, there is nothing out there that I can see that is going to try and bring more inventory to the market. Like, if you had an overbuild that was taking place, like if my yard was just hustling with people and people buying lumber and putting up structures, then I would say, okay, well, maybe we might be moving into an overbuild. But I don't see where an overbuild is taking place, not in residential homes. Like, you might have find some in real, like, commercial real estate, or even like the apartment complex that is here in Astoria. That is, like, I think they're starting to work on it again, but really it's been a long time that thing has just been sitting there with nobody at the job site. That, to me, like, those type of projects, that is a consequence to the again, to the housing market. Like, if those things are not getting completed, if the project itself is not a profitable one, then the demand for investment going into it is, or like, let me say, like, the amount of investment going into projects like that to start new ones begins to diminish, right? Because you have these projects out there that are failing. Why would you invest into doing more when you have the opportunity to pick up, like, distressed properties or something? So again, it's like, how do you add more inventory to the market? Well, you have to have investors who are encouraged by the opportunity to sell those houses, right? I will build one if I know I can sell it. That's easy enough. But it's easy enough to build, but it's hard to sell it. Then that might be like a cautionary position to adding more inventory. Does that make sense? I don't know. I'm talking out loud a lot of times on these things. Or thinking out loud. I always talk out loud. All right. Gotta be where that shit is happening, and it is. All right. Dylan, but rent is 40% of income already. Only way to change that is higher wages. I don't understand why they wouldn't want to wage increases. Well, I mean, the thing is about, like, well, that's, then it's not, the wages don't have to go up and the rent doesn't have to go down. People have to figure out how it is that they team up on that. How you get, like, roommates. How I mean, it's figuring out second jobs and stuff like that. They're like, the wages don't have to increase to meet the rents, right? People can figure out, like, this is another thing. there's so many ways of making money out there right now. Like, I think about it, even this channel right now, this YouTube channel gives me income that a lot of people who are not pursuing anything outside of a 9-to-5 job just don't have access to. But yet there is so many opportunities out there for people to go and make money. Side hustles, whether it's like doing DoorDash kind of things, selling stuff online, literally taking a part-time job and a second part-time job or full-time job even. There's so many ways out there to making money. Now, if people are doing that, like doing these side hustles and taking on a part-time job or doing that other stuff, now you have to compete against those people. Like your regular 9-to-5 job now has to compete against somebody else who not only has a 9-to-5 job, but then also has a side hustle, right? So they're able to afford the apartment, but you're not, because you're not doing those things like a lot of other people are now starting to do. So it's not a matter of the wages anymore. It's a matter of how much like income that you can do. And there's so many ways of making money now that it just really kind of takes the people who just want to work a regular 9-to-5 job. It kind of takes them out of the game. Like you can't do it like that anymore, you know? I mean, you can, but it's not going to be good. Is the only problem, you know? Let's cruise down here to the bottom. We got uneducated from Jesus. Are why does a pause interest rate pump? Why does a pause interest rates pump the crypto markets? Why does a pause pump the crypto markets? Okay. I mean, I think probably it's not the pause in the rates that are doing, like you might be able to correlate those two together as the reasonings for it, but ultimately like you have to also think like crypto is a world thing, right? It's not just the United States. So like we can look at like, whoa, the Fed made this decision and crypto markets did this, but really the crypto is like a world thing, right? It's happening all over the world, especially when it comes to like Bitcoin and other currencies as well, other cryptocurrencies. So you can look at it like that and saying, hey, this is what's causing it. Really, you have to think about it maybe in relation to the dollar, right? If the dollar gets stronger, then crypto gets weaker, right? Or if the dollar gets weaker, then crypto gets stronger, right? So that's, kind of, you can look at it in reverse to that. Now, when you have an idea that the Federal Reserve is going to move into lower interest rates, that's a weakening of the currency, right? So the idea that the Federal Reserve is going to be doing that then puts people in a position. It was just like, well, if I don't want to be in a weak currency. I want to be into the opposite of that, right? So if you have the dollar falling, then crypto would move up. And this is the perception that comes to the people. Now, whether or not that's going to be the ultimate outcome from it, that might be one of the reasons why you're seeing that pump kind of taking place, but really it's just people wanting to be in a position that is not the weaker dollar, but the opposite of that. So in my opinion, I don't think that's going to happen. Like, I think the dollar is going to continue to get stronger in a way that is much different from what everybody is anticipating. When the Federal Reserve goes to lower interest rates, that would weaken the dollar, right? And I don't think that's going to happen. I think the dollar is going to continue to get stronger, especially if the Federal Reserve pauses those interest rate cuts, right? Then the people are really going to start seeing the dollar start to strengthen after that. What happens when reverse repo runs out, in your opinion? Well, that's just the thing. Like, I don't think that's going to be as big of a deal as a lot of people are making it out to be. Like, they're thinking like this repo thing comes to an end and all of a sudden the banking system is going to freeze up or something of that nature. And I don't see it like that. Like, what we are working in is in an abundant reserve system, which is much different from the limited reserve system that we had operated in, say, prior to September of 2019. Now, we were still somewhat in a limited reserve system then, and we didn't move into the abundant reserve system until, like, the pandemic started to kick in and the Federal Reserve lowered interest rates to zero and then lowered reserve requirements to zero as well. Now, this is kind of important to understand, because the way that the limited reserve system worked is it didn't even need the repo facility. It didn't really matter, right? The Fed funds was a the Fed funds is like a target rate. So when the Federal Reserve says, "Hey, we have interest rates set at 5% or 5.25%," it's they wrote it on the wall and say this is a target that we're shooting for, guys, right here. Okay, this number. Now, the effective fund rate, that is the real interest rate. That is the Fed funds rate, right? The Fed funds rate is a target. The effective fund rate is what's actually taking place. So when the Federal Reserve is trying to manipulate interest rates, what they do is they try to manipulate the overnight lending rate at these big banks. So this is essentially where loans start. Now, in a limited reserve system, the federal or the big banks, some of them would be in excess reserves, some of them would have a limited amount of reserves, right? Would be under. The ones who had excess reserves would lend them to the ones who were in need of reserves, right? And this was on a daily basis at night, like at the end of the day, so that everybody would be balanced out to do operations for the next day. All right, so the ones who had excess reserves would lend them to the ones who were in need of reserves. That overnight lending rate was the effective fund rate. Okay? Now, the way the Federal Reserve would manipulate interest rates in that system is they would buy and sell treasuries off these big banks to limit the amount of reserves that were within the banking system. And this limited reserve system would establish that overnight lending rate, as the ones who were in need of reserves would borrow them from the ones who had excess reserves, and there was only a limited amount of reserves in the system to begin with. If they needed to lower rates, they would adjust the amount of reserves on those balance sheets. If they needed to raise it again, they would do the opposite. All right, so what ended up happening in September of 2019 is that all this cash left the banking system. Now, this was due to a major corporate tax payment. It took this cash out of the banking system, sent it over to the general treasury account, right, which is an account at the Federal Reserve that the Treasury uses to pay its bills. But importantly, it took the cash out of the banking system and sent it over to that Treasury General account, which left a limited amount of reserves that were not enough to meet the overnight left it with a limited amount of cash that was available for lending to these big banks in order to balance out for the next day. And since they could not find the funding to do that, the interest rate shot up like you wouldn't believe in order for these banks to try and find that funding that they needed in order to be balanced out to operate the next day. That's when the Federal Reserve says, "Oh, no way. We got the repo facility. We'll fire it up. No problem. You hand us a bunch of those treasuries that you have because of all this government spending that is happening. You hand us the treasuries. We'll hand you cash. You'll have enough cash to operate the next day, and we'll just keep doing this every single day." This is the non-QE QE that started to take place back then in that September of 2019. Now, as the pandemic kicked in and the Federal Reserve lowered interest rates, what they did is they moved into an abundant reserve system where they basically just loaded these big banks up with the huge amounts of reserves, completely topped them off. And now there is no way of really establishing that overnight lending rate since everybody is now full of reserves, right? They don't need to borrow from these other banks. Now they have to have a place to put this excess money, right? Well, again, there's two accounts that now the Federal Reserve has, right? They have the excess reserves, right? So the big banks can earn an interest on excess reserves with this account, or they can deposit it in the repo facility, right? So these two places that they can put the money, right, their excess funding, now channels where the Fed funds is going to be. So they can establish where the Fed funds rate is. Before, it was that overnight lending rate between the big banks, which it still kind of is, but really it moved over to the repo facility. So when the repo facility runs out of money, what happens then? Well, now they can move back into a limited reserve system, much like they had back prior to 2019. And I don't see any reason why they couldn't do that. And once they have done that, now they can reestablish the Fed funds rate or the effective funds rate in the overnight lending rate between these big banks and not even have the repo facility in operation. Now, whether or not that's the actual outcome, I'm just saying that's what could happen. All right. What time is it? Oh, bummer, guys. Okay, I spent all my time talking about the repo facility. I have to go. I cannot believe we have so many people out here watching right now. We got 494 people with 197 likes and $10 in super chats. You guys are awesome. Thank you so much for all this support and encouragement. And man, with 500 people now watching, please go hit that like button before I end the video. The YouTube algorithm loves seeing all those likes. It will pick up this video, it'll spread it around for more people to join in and watch the video, and then we actually make some money off of the ad revenue. So you know, hey, we got to do this for money, right? No good news out there, but stock market doesn't know it. Yeah, I think it will eventually. People will see it. All right. See you again next time. Well, thank you very much, Will. Thank you guys for being here. All right. Don't go, bro. I'm bored. Larry, I would love to stay out here because there is literally nothing happening at work. Like, it is slow. Phones don't ring. People are really not coming in. It is like dead. Like, I mean, it's dead like I have experienced prior to the stores shutting down, right? I mean, this is like recessionary pressures unlike anything that I had ever seen outside of a recession. Like, it's obvious to me, you know, there is a recession in retail taking place. All right, take us to work. Yeah, I would love to, Deja. That would be so fun to put the live stream up there next to my desk. All righty, guys. Uneducated Economist, you guys let me know.